Thank you for joining me for a more in-depth look at that bullish employment report. Now, unemployment came in at 4.1% for the fifth month in a row. Stock market responded with a broad-based rally, and the reason for that was the unemployment report showed jobs created across the board in construction, retail, business services, manufacturing. Almost every industry saw gains, and that's generally bullish. Now, if we look at the relationship between changes in the employment report and changes in the stock market's the blue line, employment report the green line. As you see, the trends generally move in the same direction. The stock market tends to lead at turns, and we see that here with the 2008 bottom, the top, which came quite a bit early in 2003. But generally what we see is the stock market rate of change turns before the rate of change in jobs. Now, the question with 4.1% unemployment is, can it get much better? And actually, we're in a position where it's not looking extremely great by historic standards. Here's where Ben Bernanke came in, and as you see Alan Greenspan. And as you see, prior to Greenspan, we had pronounced swings in employment. Since Greenspan, we've been more subdued for the most part, especially to the upside. Greenspan, after him Bernanke, Yellen, and we'll have to see what Powell does, has been rather quick to take away stimulus, even though they have a reputation for doing the opposite. Here's the data. Data shows they don't let job growth get out of hand. They want consistent. Now, it's likely that Powell is going to come in and set his own mark, but I would expect to see more return to what we saw in the past, with a wide upswing in employment. So I think that's where we're headed. That would be bullish for the stock market, as the previous chart showed. Where are all these workers going to come from? There's millions of potential workers on the sidelines. This is the much talked about participation rate. And participation has been declining broadly since the late 90s, accelerating after the recent recession, and now stable. Low unemployment is going to result in higher wages, according to economic theory. That's going to pull these workers off the sidelines, and that's what we're looking for to happen. Here's a close-up view of the trend. As we see, it bottomed in 2015, relatively stable now, but if it moves higher, as wages move higher, and wages are moving higher at a faster clip than inflation, which is bullish for everything. That's going to bring workers in. That's going to increase productivity. That's what's next, is as more workers come off the sidelines, there's more discretionary income created. There's more money to spend. That creates even more jobs. It pulls even more workers off the sidelines. We're at the point in the business cycle where we should expect now kind of a melt-up in both the economic data and the stock market. It looks good from here, and we're well positioned, hopefully, to benefit from a bullish trend in the stock market. Thank you for joining me. That's all I have on this chart. I'll be back later with more charts.